The 5th of November 2025. Okay, so what's in store for us today? Now, today I'll discuss about inside the Fed's 29 billion cash boost, liquidity fix or early warning. Okay, because this is pretty crucial for you all to understand. Now, overnight repurchase agreements, or better known as repos, are essentially short-term collateralized loans between financial institutions. Now, in a typical repo, one party sells a security, often a US Treasury, to another with a promise to buy it back the next day at a slightly higher price. And that price difference is effectively the interest on the loan. Now, these operations are temporary, open market operations. You hear this a lot when you read financial articles. It's aimed at smoothing short-term interest rates and ensuring banks have enough liquidity to meet daily needs. Now, in effect, an overnight repo from the Fed increases bank reserves for a day, helping keep the federal fund rate within the target range and preventing cash shortages from causing a spike in the funding cost. Now, here is the overnight repurchase agreement, the Treasury securities purchased by the Fed in the temporary open market operations. As you can see clearly over here, on October 31st, 2025, the Fed quietly pumped 29.4 billion into the US banking system via overnight repos. All right. Now, according to official Fed data, this operations was by far the largest single-day liquidity addition in over 5 years. For comparison, in the days prior, repo operations were near zero or only a few $billion, but suddenly jumping to 29.4 billion indicates an extraordinary liquidity injection. Now, this amount even surpassed the peak seen during the late 2019 funding squeeze and is second only to the frantic interventions of early 2020s at the start of the COVID-19 crisis. Okay. So such a big move by the Fed was done with little fanfare, but it could potentially signal stress in the overnight funding market. Okay. Now, why banks need this money? Now, first of all is the reserves were getting low. The banking system cash reserves had fallen sharply after a year of Fed quantitative tightening, or QT. US bank reserve balance dropped to roughly 2.8 trillion, a 4-year low. This meant less cushion in the system. Banks had far fewer excess reserve to lend to each other, so as a surge in demand for cash could not be met privately. Next was the US Treasury had been issuing large volumes of bonds to fund deficits. Bank and primary dealers accumulate treasuries that must be financed, increasing their needs to borrow cash. In late October, a slew of treasury auctions and settlements likely drained liquidity from the banks, and they were short of money. Other than that, the end of month and especially quarter end is a period when banks and financial firms adjust balances for regulatory reporting and balance sheet management. On October 31st, some institutions pulled back from lending in overnight markets, preferring to hold cash for their own needs. This can temporarily spike demand for Fed liquidity. In fact, on that day, a number of money market rates jumped above the Fed target range, indicating a scramble for funds. Other than that, we also have the reverse repo drain as well, right? So the money market funds had already pulled most of their cash out of the Fed's reverse repo facility. So there wasn't much buffer left. Okay, so these 4 areas actually caused that liquidity crunch. Now, does this mean banks are in trouble? Now, not necessarily. This was a liquidity problem, not a solvency problem. Banks weren't falling or out of capital. They simply didn't have enough cash on hand for short-term settlements. Most held plenty of treasuries, but those can't instantly be converted to spendable dollars. When funding markets tighten, they turn to the Fed's repo window, borrowing overnight against that collateral instead of paying sky-high rates elsewhere. By doing so, banks kept the financial pipes flowing. The Fed's injection acted like pouring water through a clogged system, relieving short-term stress before it escalated. Still, the move sent a warning signal. Analysts call it a flashing red light, showing that liquidity buffers had become thinner than expected. It didn't point to falling banks, but it did show that money was pooling unevenly. Not every areas are getting the money. So Fed Chair Jerome Powell seemed to recognize this almost immediately. A day before the operation, he announced that the Fed would halt balance sheet runoff on December 1st, 2025, earlier than planned, citing signs of reserve scarcity. So in plain English, the Fed saw that it had tightened too far and quietly shifted from draining liquidity to stabilizing it, even while keeping a hawkish public tone on inflation. The event also served as the first major test of the Standing Repo Facility, the SRF, a tool that the Fed built in 2021 for exactly this kind of situation. Banks borrowed around 50 billion through the SRF, showing the backstop work. Some officials had worried lenders might avoid using it due to stigma, but in practice, it functioned perfectly. Banks bought treasuries, got overnight cash, met their obligations, and avoided a market freeze. In short, this was a contained liquidity event, not a crisis. The Fed acted as a lender of last resort, as it's supposed to, and then adjusted course to prevent further stress. Now, it's a reminder that central banks inject liquidity not out of generosity, but out of necessity. When funding starts to dry up, they move fast to keep the system stable. So in the past, that has also happened, right? For example, 2019 repo spike, a similar crash shortage sent repo rate soaring. The Fed intervened, then made the standing repo facility permanent to avoid repeats. Market stabilized and stock kept rising. 2008 crisis, liquidity dried up completely and the Fed had to invent huge lending programs. The episode was about solvency and bad assets, not just temporary funding. The 2025 situation is nowhere near that scale. So what it could mean to the stock market, in the short term, the move comes stress and it's good for markets. Stocks barely reacted. The signal that the Fed might ease up on tightening sooner, which can support asset prices. Now, the risk is this: if these injections become frequent or grow larger, investors might suspect deeper cracks in the system, leading to volatility. Now, historically, every time the Fed adds liquidity to stop a squeeze, it avoids immediate crisis but quietly shifts towards looser policy, and market often rally afterwards. Okay, this is what has happened historically. Now, will it happen this time? For this, we need to look at, this part here when it comes under the risk. Would the injections become frequent or grow larger? If it does, it's a sign of cracking as well. Okay, so be on the lookout for that. Couple that with the technical analysis, you will get a good idea. With that, that's a report for today.